Hey everybody, Marty Missouri here. After hours on Tuesday, the 17th of October, with your midweek market snapshot. Clients, as usual, it'll show up linked to an email in your inbox Wednesday morning. I do think this one's going to be relatively quick. I know I say that often and then I ramble for much longer than I originally think I'm going to. This time, though, not a whole lot more to report. I mean, there's economic data that we're going to hit in more detail at the end of the week. And this morning in particular, retail sales, it definitely had an impact, at least initially, on the market. So I'll touch on that in my opening narrative, and then get into the technicals. Once again, I'll just do what we did last time, and that's the S&P NASDAQ 100 ETF. We'll look at yields, we'll look at gold, and then we'll look at the dollar again and just see what has happened the last couple of days relative to what I was looking at last Friday. So this morning, retail sales came out way above anybody's expectations, certainly way above mine, square in the face of our narrative that recession odds are rising and that the economy is about to slow. Well, there was little, at least, about the headline number that would suggest that that's the right narrative, at least just yet. Now, of course, you dig into the weeds a little bit, and not quite as robust as the headline would suggest or as it was described in financial media, at least what I caught early this morning on Bloomberg. Somewhat at odds with what we're getting from some of the earnings announcements and what we had in terms of pre-commentary before earnings season from the retail space. To some degree, flies a little bit in the face of what we're getting from the banking sector in terms of their commentary around the consumer. Rising delinquencies on consumer loans, the kind of spending looks more like it's around need as opposed to wants. And certainly in the housing sector, today the housing index came out, which is essentially home builder sentiment. It was at 40, which is a really low number and a lot lower than what anybody expected. So home builders are answering the surveys in a way that suggests that that sector is actually contracting. We're back at mortgage rates that are historically high, at least for anybody who's looked at mortgages the last couple decades. There's a housing affordability index. Maybe I'll show that later in the week. It's at the lowest in the history of the indicator. So housing affordability is the worst it's been since it's been quantified in this particular metric. So, stuff to be thinking about. What I thought was interesting, and I'll show that in the charts, was the reaction the last couple of days. Like, for example, yield blew out to the upside today, of course, with that hot retail sales number. We talked about this on our morning internal strategy call. Clearly, the Federal Reserve has circled the wagons. The message has been given, or they all agree, that they want to give a signal to the market that they're done hiking rates, but that they're going to stay higher for longer. And then you get this hot retail sales number following hotter than expected inflation data a week ago. And so the initial reaction was, particularly in the 2-year, which really reflects the anticipation for Fed's funds rate, it really shot up higher today. Because they don't believe that the Fed's going to necessarily be able to not raise again amid the kind of data that we've gotten over the last week. I don't think they should raise again, by the way. I'm on record as saying I think that is utterly unnecessary based on what we think the trends under the surface are in the economy, and that is a slowing. So bonds reacted really negatively, sold off, yield spiked. Gold, which has been largely trading on the prospects for real interest rates, actually had a decent day today. 19 basis points, it's not huge, but it's not down. Bonds were down 110 basis points, our long-term treasury ETF. So that was interesting. So what does that say? I mean, it's just one day, but if this were to develop into more of a trend, and there's a little bit of a very short term, just a matter of days trend, when we look at yields, we look at gold, we look at the dollar, that just aren't correlating the way they have, say, this year, right? So if bonds are essentially selling off and gold is rising, and if gold is indeed trading on real interest rates, well, rather than reflecting in anticipation of some real pain, which is really what I think ultimately gold will trade on. Today, you could argue that it's reflecting the fact that the Fed isn't going to raise interest rates, and that inflation's therefore going to get hotter, and that the spread between interest rates and inflation will actually contract, meaning real interest rates will come down, and that's a very bullish scenario for gold. Ultimately, before this cycle completely plays itself out, we think it'll be yields dropping with underlying inflation that's going to stay relatively stubborn on a long-term basis. We think that's how real yields favor gold. Could be today that it's the fear that inflation's going to run hotter and the Fed's not going to push interest rates any higher. So I'm just trying to probably overthink it, actually. But interesting dynamics, things that you just kind of make a mental note and say, hey, let's chart this and let's see how that trends going forward. So I've pointed to relatively bullish technicals that say, we could have an early October rally. Well, we got that, okay? Will that morph into a Q4 rally, which is not at all unusual when you look at years historically? Not all of them. We've had some rough ones. 2018 was terribly rough. But, you could make that case, particularly if, like the economist who I just spent some time paying attention to before I hit the record button, sees a second half of next year recession. Then you could be pretty sanguine for the fourth quarter, and then you start getting into the second quarter of next year, then you've got problems for equities, right? But if it's sooner than that, then equities become a problem any day now or any time right here. So you got to look at it from several angles, and I could make a very bullish case right here, at least short term. I could make a relatively bearish case. At the end of the day, if we're allocating our long-term money, in our case, managing our clients' long-term money, it's not about what's going to happen in the fourth quarter. It's about what is the general setup right here. The long-term setup, actually, I think, if we look past this cycle, I think it's very bullish for lots of things that we think are going to be very, very attractive if we get a recession sell-off. In the near term, though, we think the downside risk is too high to add in a big way the positions that we're looking forward to, or to add measurably much more volatility than we're already accepting right here. So again, this is the message that I keep pounding home over and over again. There's a time to add risk and to add and accept more volatility in a portfolio. This probably isn't one of those times in our view. So folks, I will just stop it right there. Hope that made sense for those of you who don't want to stick with me on the technicals. For the rest of you, here's the S&P 500 daily chart. Each bar is a day going back to October of 2021. This is a very distinct downtrend line. I told you we had a bear flag here that ultimately failed. Well, actually, it looks to me like I need to adjust that and tell you that this now looks like a new, perhaps more meaningful bear flag pattern. Pretty steep flag there, though, so we'll see. I don't want to try too hard to make a pattern here. You want them to really kind of jump out at you. But this one, this doesn't look terribly unlike this flag pattern that we had back here right before the market hit the bear market bottom that we've seen. So the so far bear market bottom. So you see how that we had a pretty good sell-off, pretty steep move in the other direction, and that precipitous fall. So we'll see. Now, again, doesn't have to play out, but yes, indeed, the S&P does seem to be losing the battle against the 50-day moving average that is sloping very decidedly downward, and then we've got this overhead right here. So just on the price chart, not a great look for the market right here, at least not for the S&P 500. In terms of the momentum indicators that have worked well for us, we still have our buy signal here on the MACD. If this rolls over, though, we're about right here where we got the sell signal. If this rolls over, we'll have quite the bearish divergence. Bulls definitely don't want to see this against a pattern like this right here. And then kind of in the middle on the RSI, same kind of thing. We'd have a real bearish divergence right here if indeed that rolls over and momentum rolls down. As for the NASDAQ 100 index, or the ETF we track, going back to August of 2021, you can see in even more hits there, a more defined downtrend line there. I don't think that looks like a bear flag. That was a failed bear flag there, but different pattern here than what I just showed you on the S&P. 370 looks to be pretty stiff resistance, which makes some sense here when you look at all the action along that line. Losing that right there is not a good sign. So battling between 370 overhead resistance and the 50-day moving average so far. When we look at momentum via the MACD, basically the same thing. Nice buy signal there. You don't want that to roll over, or you're going to have this, and it looks like you may be rolling over there on the RSI. So the technicals are a little bit ambiguous. You get some good earnings and some more favorable Fed speak, and if we got some weak economic data, as I said, and I made it a real point to articulate that weak data actually will see, particularly the NASDAQ 100, rise initially. Weak data, though, jives with our longer-term thesis, and that is weak data is going to ultimately turn into a recession, or at least odds are too high there for comfort that that's what will happen. So be careful what you ask for. The 10-year yield, remember, it looked like we were breaking down below this long rising wedge here, and then we held right there on the uptrend line, and then kaboom on the retail sales number right in there. So we'll see. Ultimately, since we are kind of in that recession camp, or I should say odds favor recession, ultimately yields come down. We think it's probably not a bad time to be slowly and methodically allocating into longer duration bonds, which is something we're slowly doing in our core portfolio. Gold, as I mentioned here, remember gold broke down and then snapped back, huge gap there. Very interesting action here in the face of rising yields. Again, here's your gold trend line, right? And here's your yield trend line, right? So negative correlation, except here just very recently. What does that say? Well, I speculated in the narrative, but time will tell. We're long-term bulls on gold right here. And then lastly, the dollar. We were bullish the dollar at the beginning of August. We went neutral in September, kept going up anyway. We stayed neutral in October, and you can see the dollar's kind of bouncing around. Typically, a falling dollar, the way things are trading right now, has been bullish for stocks. We got that big pop here. Today we got a big pop in yield, but we didn't get the big pop in the dollar, which is very interesting as well. So very short-term stuff. A day, a week does not a trend make, but just interesting signals across asset classes. And folks, I will leave it there. Thursday you'll have a written note, and then Friday we'll do another update like this, and then we'll do the economic assessment. Folks, thank you as always for watching and listening. Hope you have a wonderful day. Talk to you soon. Bye-bye.